Hey guys, in this video we're going to be looking at who actually benefits from the Black-Scholes model and basically the stochastic calculus for finance and the different kind of stochastic processes. What we are interested in is actually how people make money. So in the last video I talked about the pricing of the derivatives, and again I then said if you just like any business, you want to price it, you want to mark it up, you want to sell it. In terms of the market makers, they need to both add a bid price and ask price in order to create a market, and then the spread is actually what they earn. So we're going to be looking at it. So we're just gonna go through the boxes, and you can always just pause and read it for yourself if that's what you like. And theoretical pricing models. The market maker use this pricing model, such as Black-Scholes model, to determine the fair value of the options and other derivatives. These models help them to estimate how costly and risky it will be to replicate the option. Primary goal is to set a bid and ask prices around this theoretical value to ensure profitability regardless of market direction. So that's what they want. To manage risk, market makers employ various hedging strategies. One common approach is to create a conversion protection package. It involves holding a combination of long and short position in the underlying assets and related derivatives. This package helps them to mitigate risk associated with price movement of the underlying assets. Then you have the delta hedging, is a technique to use to neutralize directional risk. Market makers continuously adjust their position because the delta is the first derivative and the underlying of the offset changes in the options delta, which makes the sensitivity of the option price to change in the price of the underlying assets. Allow them to focus primarily on managing volatility risk rather than price movements, which is important. Bid and ask spread. Market makers profit from bid and ask spread, which is the difference between the price. So they're going to buy and sell the derivative. By quoting the prices that's slightly higher for selling and slightly lower for buying, they can earn a consistent profit on each transaction while providing liquidity to the market. So we just go down to the last point. Conclusion: in practice, market makers use a combination of theoretical personal hedging strategies, delta hedging, and sophisticated risk management techniques to price derivative accurately. The primary objective is to maintain market neutrality and profit from the bid-ask spread while providing liquidity to the market. So their primary objective is to actually just provide liquidity to the market. And they don't want to take any other risk. They don't in speculating on whether Tesla is going up or down and whatever way they are. So because that's not their core function or core operations. Moving to this text box, you can see why they are different from other investors. You have, unlike the institutional and retail investor, market makers have obligation to provide liquidity by posting firms simultaneously two-way quotes of comparable size and competitive prices. We're going to be looking down here soon. Can engage in certain activity that might otherwise be restricted, such as uncover short selling, to fulfill their market making role. I believe if you want to do this for a retail investor, you have to have margin in order to do this. To put up as collateral, yes. And the last point are expected to hold significant short position only for brief periods. So let's say provide liquidity by posting firms something two-way quotes of comparable size and competitive prices. Let's go down here. They have specific obligation to provide liquidity. Two-way quotes, market must provide both bid and ask price simultaneously for security they cover. This means they are always ready to buy both and sell, which is interesting because if you want to do it and you are a retail, you can't really do it, because if you try to add in a buy and a sell without actually or a sell and then a buy, I think it will be flagged as spoofing, if I'm correct. If anybody know, I haven't checked right out, but I think it's called spoofing, and that's illegal. So your broker will most likely reach out to you and explain why you did what you did, and I have heard that it can be a lot of pain just to answer those questions. But the market makers are allowed to do that. We're gonna be looking at how they can do that. Market maker are, when we are talking about firm quotes, the price quotes by market maker must be firm. That's what they mean by they are obligated to execute trade at those prices when the order comes in. So they can't back off when the order is filled. When the order comes in. If you go down here, we can use point 7. You can see user designated accounts. Market maker typically use specific accounts, M accounts, this to distinguish their market making activity from proprietary trading. And also that they need to comply with, so they are able to do that. But it is the M account which allows them to both buy and sell at the same time. That's very important. These obligations are designed to ensure that market makers contribute to market liquidity and stability, facilitate efficient price discovery and smooth trading operation. By fulfilling these requirements, market makers play a crucial role in maintaining orderly and liquid markets. So I just wanted to understand for myself, of course, if you guys, and for you guys to understand how to determine optimal bid and ask spread. So if you guys want, you can just press pause and actually read through. So they have what is called the inventory management. Based on the inventory, they adjust their quotes. High volatility gives them, then they most likely have more wider spreads in their options, and in calmer markets, spreads tends to be narrow. And then the same goes for liquidity. If high liquidity, lower spread; low liquidity, high spread. Order flow imbalances, is there more buying selling pressure? They may raise both the ask and bid and ask prices, and the same for the selling prices, just the opposite way. Market maker factoring cost of hedging the position when setting spreads. This is very important. Remember this, because I want to talk about this in the next box. The requirements must adhere to certain quote obligations set by exchanges and regulatories. aims to earn the spread while managing risk. They set price to achieve the desired profit margin. Competitive position market may compete with each other to offer the best prices while still maintaining profitability. Technology capability, advanced algorithm and low latency systems allow market makers to rapidly adjust quotes based on changing market condition. Very important that also. That's actually an important factor. Risk management, why the spread may be used to manage risk in a certain market condition or for security with higher perceived risk. So back to the hedging cost, because when they are obligated to fill the prices, and then when they want to hedge their own positions, when they are giving the bid and ask pros, it must cost them something. So that's what I ask Perplexity. You can of course use it as you of course subscribe to them and use, no affiliation there. So you can just see, yes, it does cost market makers to set up hedges for themselves, which is what I was interesting to understand. But the question is, how do they actually then pay for it? So do you need to have like initial capital on hand, or how do you actually do that? And then it tells you that it's all adjusted in the spreads. So the spreads is basically the main way to how they actually can afford to actually put on other positions for the hedging. So rebalance of these costs are factored into their pricing models and affect the spread they offer, which is very important and very true. And then you have the operational costs, which is just operational expenses associated with maintaining the infrastructure and the systems necessary for effective hedging and risk management. So that's actually what I just wanted to go through this, just to get a better understanding for myself and for you guys, that who actually benefits from the Black-Scholes model. So it's the market maker primary, and then you have more add-on questions like, alright, how do they do price discovery? But if they want to hedge their own bid and ask, doesn't it cost them? Are they exempt and not pay for that? But yes, they do actually pay for that, but the way they want offset that cost is by setting into the spreads that we see. So that's all. On any points when I'm going through this video, you can always pause and read it for yourself. I just wanted to create this video for you guys and for my own understanding, just to get a better overview for how actually market makers earn their money. So it's most interesting if you want to ever work in a market making shop, that you should actually take stochastic calculus for finance, because I think that's a minimum requirement for them, and then you're gonna go through rigorous interviews to actually be selected. Yes, so that's it for this video. I hope you guys found it interesting, and then I'll see you guys in the next one. Bye.